everybody, Adriana Turk here with Best Life Realty. Hope you guys are all doing well. So today guys, I want to address a couple of different things. So first and foremost, I keep having people call me and ask, when is the bottom going to fall out? Are we in this bubble? Are we in this bubble? Well, the short answer to that, we're not in a bubble, guys. I know it seems like we're in a bubble because it's very similar to the demand that we had in 2008, but it's not in a bubble. And there's a couple of different reasons why it's not. Then in order to understand that, you have to know what actually caused the 2008 housing crash. Now, the primary reason that there was so many foreclosures and that the housing market crashed in 2008 was because at the time, there was loans that were being given to people that should not have had a loan. Short answer. So people that could not verify their income, that did not have the income, that had too much debt, they're basically meaning that their mortgage payments along with any loans that they had was much too high, and it was going to be impossible for them to be able to afford to make the payments as well as make it on loans, which resulted in, of course, a lot of people defaulting on those loans. Banks were issuing loans to people without having any kind of financial status, without having any kind of financial information. They were literally taking what we call stated income to qualify people for a mortgage. What that means is you would call the bank and say, hey, I make $2,000 a month, I make $4,000 a month. And the banks were not verifying any of that information. So they had no proof. They had no backing as to this person is reliable and this person actually has sufficient income coming in to be able to make those payments on the house. The other thing that what they were doing is like I said, they were issuing loans to people that their debt to income was too high, which means that their loans, the amount that they're paying for their mortgage, as well as any loans, credit cards that they had, those payments were going to be much too high. So in some cases, even as high as 65% of their income was going to debt. So for example, that would be if you're saying making $4,000 a month, your debt was probably close to $3,000 a month, which is quite substantially high. And $500 after paying all your debts, payments, credit cards is nowhere near enough, not even in that area, enough to, of course, live off of for groceries, basic utilities on top of paying all your debt. So of course that's what resulted in the housing crash. So all these people that probably did not have the qualifications to get a loan by today's standards were able to get a loan, and as a result of their debt to income being too high or there being no verification of their income, they defaulted on those loans. And really that's the primary reason why the housing market crashed. Now fast forward to the last couple of years, the government has put in tons of regulations and truth in lending, such as TILA, RESPA, which are devoted to consumer protection bureaus, such as organizations like that are geared towards doing anything they can to try to prevent what happened in 2008 from happening again. So now when you get a mortgage, you have to verify your income, you have to verify your credit. The bank has to make sure that your income, your debt is not higher than, in some cases, 40 or 50% of your take home. So they actually are verifying all those things now that they were not in 2008. In addition to that, there's also disclosures that you have to get when you first make a contract for the house, as well as again at closing, so that they can make sure that you are understanding of the payment and that you are comfortable with the payment that you're going to be making. And now before, that didn't happen sometimes at all until closing. So now the government has put special regulations in place that you, consumers, have to know what your interest rate is. There's not as many loans out there that are done with flexible interest rates, which was again another problem. They would do a fixed interest rate for the first few years, and then after that it was a ridiculously high interest rate. And a lot of times people did not read the paperwork, so they didn't understand that their interest rate may have started out at 5 or 10%, but then it was going to go up to 15% in 5 years. And of course, by then, people a lot of times did not have the income to be able to refinance into a fixed rate. So today, those standards for lending are a lot more strict and they're a lot more stringent, which unfortunately for sometimes buyers, it makes it harder for you to qualify. But as far as banks are concerned, it makes it so that any potential buyers that buy a house are a lot more secure when it comes to issuing the loan. So really, that is the best way that I can describe of why we are not in a financial bubble. I know it seems like it is a lot because we have an increased demand, which is a low supply, which I'll address in another video, but realistically we are not in a bubble, guys. So I don't expect the bubble to fall out. If anything, it will level off once the supply levels off a little bit with the demand, but we're going to address that on another issue. But so if you're waiting for the bubble to fall out to purchase your house, you're probably going to be waiting for a while. If anything, prices are probably going to continue to rise like they have in the last couple of years. Even through COVID, even through interest rates rising this year, home values are still staying steady and they're still going high. So if that's what you're waiting for, you should probably do it now, because I don't see the bubble falling out. I don't see the big bubble pop that many people were expecting of 2008, where homes are going to just spontaneously start getting all foreclosed on and come on the market and be ridiculously cheap in the $100,000s. Unfortunately, guys, I do believe that those days are long gone. So if you have any specific questions, please give me a call.